Yo, what's going on, everyone? So, I want to throw out a couple of tips on how I became a profitable trader. I'm confident that the experiences that I went through in the early stages will help you all push for the next step in finding your own profitability. I'm going to go over 8 key points. We'll go over 8 different ones, which I contribute to my success as a trader. If you want me to go in depth with any specific point, just let me know in the comments below. And if you want a very good trading resource, I'm going to link my Instagram in the description below. I post daily trading recaps on here and very good trading tips and tricks that you really won't find anywhere else. It's a very good resource and you're missing out if you aren't following it in the description below. So now let's get right into the lessons. The first step, which really put me over the edge to profitability, is using only price and volume. It's very key for you to understand how the auction facilitates trade. It's something that I stress with Trade members, and they know it when they go through the video lessons. Nothing else can move the market, whether you're talking about the stock market, a real estate market, a car market, besides price and volume itself. People's intentions, people's supply, people's demand, and the volume of the sales coming through the market are the only things that can move the market itself. Now, how I relate this to the stock market is only focusing on price and volume of an option, of a stock, of a future. I trade off of supply and demand price imbalances. Now, the idea here is when the supply or demand equilibrium is out of balance, we look for the market to come back into that area and we either A, take it long at demand, or B, take it short at supply. For example, this trade that we took last week in the Discord, we had a demand zone or an area where buyers showed interest and caused an imbalance at a previous point in the market. At the 358.80 area, Facebook sold off into this demand zone and proceeded to bounce. This is the area we look to play a bullish position, whether we're longing a stock or buying the option in hopes of the market moving up, increasing in price. Another example would be puts at supply or any type of bearish position once the market hits supply in anticipation that we are going to move back down because this is a supply imbalance where supply exceeded demand at one point in the future and caused the price imbalance. And in a perfect world, the market will move from supply into demand. It does not happen all the time, but we could use demand zones as a target for our short positions. When I first started trading and I honestly had no clue what I was doing, my charts honestly looked like this. It looked like my 3-year-old cousin drew on my computer screen. And this to me is more confusing. This to me, these indicators do not physically move price other than volume and price itself. This is all noise. And if you do something like this, you're going to try to look for a holy grail, something that works 100% of the time. And you're going to be bouncing back and forth looking for different strategies. Does this work for me? Does that work for me? Did that thing I used last week work for me? The best piece of advice I could give you is stick to one strategy. There's no such thing as a holy grail. And understand how the auction moves. It doesn't move because of those indicators. It only moves because of price and volume, volatility, volume, and momentum itself. Those are the only contributing factors. Now, the second point, which is a very key component in my strategy, is developing context. The market is all about context. What happened yesterday is not the same as today. The market 2 weeks ago or 2 months ago isn't the same market we're in today. But what will always be the same is where are buyers and sellers interested. This is what I mean by context. Where are other buyers long? Where are other sellers short? The market moves based off of effort versus reward. Are sellers showing effort or buyers showing effort? If they don't get rewarded, the market is going to reverse. If they do get rewarded, we're going to see continuation. Do we have economic events, earnings, Fed speaking? Is it affecting volume? Is it affecting volatility? The market is the storyteller, and our jobs as traders is to not only hit the button to buy or sell, but it's our job to comprehend and put context clues together from what the storyteller or the market is trying to tell us as traders. Now, another thing which is very important is following my predetermined plan. Before any trade I put on, I need to have a valid thesis. Now, what I mean by that is my trade needs to be planned out before I physically hit the buy or sell button. Now, you do it to a point where you bend the stick a little bit and react to the market, but you don't bend it enough that it's going to break. I need to have a planned entry, a planned exit, planned stop loss, and proper confirmation signals that I look for. I have plenty of them. I don't just buy something because it's going up, and I don't just sell something because it's going down. When you're buying something based off of impulse or you see the market moving, you're making an emotional decision. And I could guarantee you 9.5 out of 10 decisions you make based off of emotions are going to be losing trades because you're trading off of your gut and what you think is going to happen. So for example, here is this Microsoft trade. I posted this in the pre-market plan. I post these every single day in the Discord. We had a very key area that buyers defended every time we test it. At the 276.51 zone, above this demand zone, we are bullish. We started wedging above this demand zone. We tagged it, and this was an area that we've looked to play calls and capitalized on a 4-point rally to the upside. Now, at this point, when I'm longing in demand, let's just say I get valid confirmation when we break the wedge. If we are playing a little conservatively, maybe we played a little aggressive and we got long at this demand zone, which would be better for our risk to reward, but the chances of it working out are much slimmer. But if we waited for the wedge break, our risk to reward is a little higher, and the chances of it working out are a little higher as well. So it's all about the personality and the trader that you are, but both are valid areas to get long. My stop loss probably would have been around the low, or once we failed to put in a higher low. And at this point, I'm riding the trend up. This broke all-time highs. And at this point, I'm using my take profit strategy. I'm following the trend, and I'm not getting scared for minor pullbacks to the downside. Same thing with Facebook last week. Came into the demand zone. We bounced out of it. We came back down and tested it. Maybe you got long over here. You got long at demand. It depends on your personality, but both are valid areas. When I enter the market, I know where I'm going to be wrong based off of the chart. I do not base where I'm going to be wrong off of a percent or dollar amount. Instead, it's where I will be wrong based on the chart. And then I let the trade breathe. I let it ride, and I protect my profits so the trade can never go red on me. It's also not based off of any emotional decisions. It's backed by facts and not by opinions, because as soon as I get my ego to take over what the market's saying, I'm going to make a trade based off of my gut. And like I said, the trades that I make that are based off of my emotions are irrational, and anything irrational in the market is going to cause pain, and anything that causes pain is going to cause me to deplete my account and lose money. So make sure you're trading off facts and not opinions. Now, the next couple of tips really have to do with emotions and mental capital. My trading is the way it is because of how strong I am, not about my market knowledge, but also about my emotional knowledge and knowing myself as a trader and as a person. So detach from the money. People get into trading for the wrong reasons. Obviously, we are all here to make money, but I don't trade to make money. I don't wake up, out of my bed in the morning and say, "Oh, I want to make, $5,000 today," or "Oh, I want to make $200 today." You do that, you have the wrong mindset. I don't trade to make money. I trade to trade my plan and my setups because that's what will make me money. I know if I follow my plan, my edge, my strategy, the money will be a byproduct and it's guaranteed to come. If I trade because I want to make X amount of bucks, I will lose 10 out of 10 times. You also need to remove the need to make money right now. If you compare yourself to any other trader that has years on this journey, you are going to start taking irrational trades, and you need to remove your need to make money right now. I did not make money in my first 2 years of trading consistently. It's a process, and the minute you rush the process, the quicker you are going to be out of this game. It sucks because everybody over social media claims they have a strategy that works 100% of the time. They're driving Lambos, they're wearing Rolexes, and people think it's possible right now, which it is. I'm not going to knock it. However, you have to remove your need to make money right now and detach from the money. Instead, focus on the process. Delayed gratification over instant gratification. If you can't wait, then trading's not for you, because trading requires an immense amount of patience. Now, the fifth step is risk management. Smaller size when you're first starting out. I don't know why, but people think they swing for home runs and eventually they're going to strike out. They go with, let's just say, a $5,000 account. They'll put all $5,000 into one trade. They'll trade 50 contracts and they'll take a $2,000 hit. When you're first starting out, go smaller size because trading is very scalable. If you can make money with one contract, there's nothing stopping you from making money with 10 contracts. But to do this, you have to be disciplined enough to respect your stop loss. Going back to that chart, if I got long, let's just say at the first yellow circle, the market starts moving back up. If we start reversing and it doesn't work out, I'm going to cut my loss. For example, I took this trade on NASDAQ today. I took a losing trade on it. I saw very strong signs of absorption at the 1504 level over here. I was playing QQQ calls, some nice volume, some nice signs of absorption, and I took calls right here. Did I know that this trade was not going to work out? No, because then I wouldn't have taken it. I had pretty high confidence that it was going to work out. But not every trade will work out 100% of the time. What's important is if you respect your risk. I got in at such a good point that when the market did not go with my analysis, I stopped out, I took a hit, and now at this point, I'm just focusing on the next best setup. And eventually I took, let's go over here. I took the S&P 500 short today. I took a $2,000 hit on the QQQ calls. And 20 minutes, 30 minutes later, I took SPY puts after we put a lower high in, after failing to bounce at this demand zone. And I rode the trend all the way down into the next demand zone at the 4380 area. So not every trade is going to work out. You're losing trades. You have to respect your risk. Do not put your head down. I was telling everybody in the Discord today that if you take a losing trade, if you get discouraged, you're going to miss the next best setup. Your best trade that you might take ever in your career could be your next one. So be prepared for it and don't deplete your mental capital because you took a losing trade on something. The only thing you can do, since we don't predict and we don't know what's going to happen next, is if you are disciplined enough to respect your stop loss and you live to fight another day, you play defensive over offense once you accept and realize that not every trade will work out. Now, point number 6, this is at the top. This should be at the top of my list. My journal is like a Bible. It's so sacred to me. You know, it's worth so much because my journal tells me what works the best for me and it tells me what doesn't work for me. So if I didn't have a journal, I wouldn't have this data aspect to my trading. I wouldn't know what I make the most money on. I wouldn't know what my emotions were back 2 months ago when I traded, Apple, let's just say. And I wouldn't know next week that, this trade on QQQ didn't work out for me. So it's putting the pieces together. I log and journal every single thing every single day because it helps me, keeps me on my toes. It helps me with context. It helps me understand what's working for me right now and what's not working for me. Every single weekend, I review, reflect it, and put it into action. That's the only way you're going to get growth and progress is if you review, you reflect, and you put it into action. You have to put in the work. You cannot be lazy. A lot of people are lazy. They think, I could be a millionaire trading this year. If you don't put the work in and you are lazy, this is not going to work out for you. I hate to say it. Point number 7, another big one. Once I removed all the noise, I saw a crazy increase in my profitability. I was going through Twitter, following 100 other people. I was looking for alerts, looking for other people to tell me when to buy and sell. My charts looked like my 3-year-old cousin drew on it. Tons of different indicators. I was scanning for high volume stocks breaking out. I also had outside trading distractions. All of this is noise. Your trading needs to be as clear as possible. So if you have any of this, you are making trading 10 times harder on yourself. And you also cannot rely on any other trader's opinions or have their own conviction. I see it all the time. Hey, should I buy here? Or hey, should I sell here? If you cannot come up with your own plan, like I mentioned earlier, or your own thesis based off of your own edge, no one else is going to make you money besides yourself. You need to have your own conviction. And the only way you're going to have your own conviction is if you have skin in the game, you take losses, you journal your trades, you follow your plan, and you respect your risk. The last step I want to leave you guys with is to be in the present moment. You have to react to what the market is currently telling you. I was a trader sitting at my desk like a statue, right? and the market would throw little stones at me, throw little hints. And I would just sit there and the stones would bounce off me and I wouldn't deflect it or react to it. Now I'm focused on being in the moment of the market, because what it's currently telling me and the signs that it's reading off to me is what is the most important. You have to adapt to its context and trade accordingly. React, be in the present moment. If you are not, it's going to be so much harder, and it's all about adapting and reacting. So I think that's going to be it. If you enjoyed this video, I don't know if it's me rambling on too much, but I really do contribute these points to my success and profitability. If you have any questions, let me know. Be sure to follow me on Instagram. Drop a like on this video. I'd really appreciate it if you learned something from it. And if you really want to learn more, I offer a very in-depth and educational course in the description below. It comes with access to the Discord, and you'll have all the video lessons on the website. So besides that, I'm going to end it. Peace out.